Hey everyone, Mortgage Nerd here. So I want to talk to you a little bit about debt consolidation and recessions. Here's a software that I have that allows me to compare what you have right now as far as your mortgage and your debts, and to see if you were to refinance even at a higher interest rate, if you were to refinance now, would it be beneficial to you? Not just the payment, but how much money long term are you going to save? So here, in this case, this person bought their house at $500,000. It was in March of 2019, so over 3 years. Estimated home value now is about $700,000. It's pretty realistic. All these debts here are theirs that I just made them up. Credit cards, student loans, a vehicle, a total of $105,000 is owed, $1,450 payment in total from all of them. You look at these bars here and you think, man, this is worse. Why would I increase my loan amount by $120,000? I'd have less equity and my interest rate goes up. This is a terrible thing. Why would I ever do this? Let's keep looking. The existing loan started off at $400,000, 30-year fixed at 4%. That's where rates were in 2019. The estimated remaining balance now is $376 because you've paid it down, and your monthly payment is $1910. We add all of your debts and obligations, and that's what shows up over here. And here's the proposed loan information, including closing costs. We're adding $10,000 in closing costs. I'm putting a rate here of 5.875. Could be lower, could be higher, all depends. Click the button calculate, and now it's going to tell us everything we need to know. Is this worth it? Is it not worth it? Property value $700. The loan balance we went over. The equity is less. Closing costs eat into some of that equity, and your estimated available equity after that. So 4% rate to a 5.875% rate, no mortgage insurance. You had debt of $105. We're including all that debt. I can select certain debt. We don't have to include it all, see which ones work, which ones don't. But look, the existing payment, all the debts, is $4,160. The payment that is proposed, if we increase your interest rate from 4% to 5.875%, but your payment still goes down, $451 a month. Now, you might be saying, why would I roll in short-term debt, like the car payments, into a long-term debt? Well, number one, remember, your mortgage interest is tax deductible. I'm not a tax professional. Seek out advice from your tax professional and see if it is tax deductible for you. But it is a lot of times, so it might be beneficial there. But either way, $451 a month savings. Let's say you are worried about what I said, where you're putting short-term debt into long-term debt. Fine. Don't save this money. Don't spend this $451. Instead, take that money, add it to your mortgage payment, the new mortgage payment. Let's see what happens there. You're still paying the same amount of money you would now if you did not refinance, but you're adding that extra money to your principal. Now you're going to pay off your mortgage 8 years faster. You're going to save $106,000, almost $107,000. That'll be your increase in net worth. Let me show you a little bit more of a breakdown down here. After 5 years, you've increased your amortization. You've increased the amount of equity you have. After 10 years, you've increased it by $58,000. After 21 years, you've increased it by $221,000. That includes all the debts and closing costs. So no matter what, doing it this way, you're going to be in a better place. Whether you're not making the extra payment and you're pocketing this money because, hey, inflation is here and your cost of living has gone up, or you're just going to keep paying that same amount of money, and in the long run, you're going to pay off your mortgage a lot faster. That's what I could do for you with this debt consolidation tool. Let me know if I could help you. Mortgage Nerd out.